Hey everyone, and welcome back to another video for today. So Nvidia is going to report their quarterly figures Wednesday after the market close. It's going to be a pretty interesting and important one as well, because as you might have noticed, there has been a lot of weakness and some questions that are being asked. Some of them remain unanswered with regards to this whole AI revolution. So let's go over the numbers for Nvidia. Let's talk about a couple of, key questions and answers that we would like to know Wednesday after the market closes. I'll go over a couple of clips as well and things that other big tech players have told us over the past couple of months. So right now, Nvidia is trading at around $190 per share, market price $4.6 trillion, a trailing PE of 54.2 times, and a forward one of 32.5 times. This is still a company, $4.6 trillion in market cap, that is still expected to grow revenue on a compound annual growth rate for the next 2 years, 49.2%, and EPS closer to 50%. That, of course, is including the fiscal year that they're in right now. Fiscal 26, 31.1% year-over-year growth for revenue, and then 17.1% year-over-year growth in fiscal 28 to reach $316.5 billion. Looking at free cash flow, that's expected to grow by 60% for fiscal 26, 41.2% fiscal 27, and 18.4% fiscal 28 to $162.9 billion in just free cash flow. And so before continuing, if you enjoy this type of videos, hit all the buttons, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, if we go and look at their own guidance for Q3, the quarter they report Wednesday after the market closes, they're expecting $54 billion plus minus 2% in revenue. That does not assume any H20 shipments to China. If geopolitical issues recede, they could ship $2 to $5 billion in H20 revenue in Q3. As for gross margin, 73.3% on a GAAP basis, 73.5% on a non-GAAP basis, also here plus minus 50 basis points. They continue to expect to exit the year with non-GAAP gross margins in the mid 70% range. If we look at what the analysts are expecting Nvidia to report, they're looking for a number around $54.9 billion in revenue, EPS to come in at $1.25. Looking at free cash flow, analysts are expecting it's a huge jump here, and the range is quite big, but the consensus number sits at $27.69 billion. A couple of weeks ago, there was the GTC October event. They said the following thing: over $500 billion in cumulative Blackwell and early Rubin ramps through 2026. Blackwell growth rates is 5 times the growth rates of Hopper. They've seen 20 million Blackwell GPUs, each containing 2 GPUs, in the early parts of Rubin compared to Hopper's entire life of 4 million GPUs, excluding China and Asia. Grace Blackwell performance 10 times the performance per GPU compared to the H200 achieved through extreme co-design. Then as for the token generation cost, Grace Blackwell NVLink 72 produces the lowest cost tokens in the world due to its superior token generation capability relative to total cost of ownership. Moving further back, September in this case, they said the following thing: in Q2, data center revenue grew 12% sequentially with a target of 17% sequential growth in Q3. Networking experienced tremendous sequential growth, nearly doubling. Gross margin is on track to return to mid 70% by the end of the year. And according to them, the market for data center infrastructure capital requirement is projected to reach an astounding $3 to $4 trillion by the end of the decade, with $1 trillion expected within a couple of years. Of course, again, with all of the questions that are being asked right now, with the sentiment being worse today than it was, let's say, a couple of months ago, it's going to be interesting to see what Nvidia, the number one player, has to say on Wednesday with regards to the state of the whole industry, demand, supply constraint, what they're hearing from their customers. Because remember, the whole pullback started because of this.
Hanging over the market is how can the company with 13 billion in revenues make 1.4 trillion of spend commitments? And you've heard the criticism,
First
Sam.
of all, we're doing well more revenue than that. Second of all, Brad, if you want to sell your shares, I'll find you a buyer. I just, enough. Like, people are, I think there's a lot of people who would love to buy OpenAI shares. I don't think you would
including
want to sell,
myself, including myself.
Excluding myself, but that's beside the point. After this, of course, Brad asks here a very normal question, especially since he is a big investor in OpenAI. Very normal question. You can clearly see the body language of Satya even when he laughs. He's not that comfortable. Brad, definitely not comfortable here. But okay, it's a very good question. Did we get an answer? No, we did not. No, we did not. Now, we did get some estimated or assumptions from the information with regards to OpenAI and Anthropic. So, OpenAI and Anthropic by 2030 are expected to generate OpenAI $200 billion in revenue, Anthropic $147 billion in revenue. Anthropic, free cash flow wise, is expected to be free cash flow positive already in 2027. OpenAI only 2029, but that goes up quite quickly by 2030. Again, these are assumptions. These are probably assumptions that are being made based on internal data that was available to them. Now, Anthropic is, of course, not really that consumer focused, right? To me and you, more towards enterprises. OpenAI is more a B2C, although there is definitely a B2B there as well. But yeah, if those numbers are going to be reached by 2030, then I'd say, okay, fine. But these are some very aggressive assumptions. Me, personally, what I would love to see is I would love to see these companies go public. Because once they go public, we can actually see what's going on in there. Sam wants them to go public so that the short seller can get crushed. I want you to go public so we can actually see if you're really going to generate money in the future. Now, I know I said the pullback started because of that podcast, but the pullback started because of the podcast and because, well, a lot of names were just overextended. We were on a 6-month run where the market just kept on going up and up and up, and now we're getting a pullback. That's fine. But then, yeah, you had these questions, right? How much can you charge for old GPUs? Because we've heard from people that they're still using A100s, early Hopper generations as well, which is fine. Which, again, those are GPUs that came out, 5 years ago or something like that. So depreciation-wise, it works out, right? Because the question here is, okay, 6 years, 5 years, although Nebius, I think, is closer to 4 years. But what if it's not 6 years? What if it's only 3? Then financially, all of these companies are going to take a huge, huge hit. This is the big question. Then, of course, if you're still using A100s, H100s after all of these years, okay, that's great. How much can you charge for those GPUs? Some people say it doesn't matter how much you can charge as long as it happens after the 6 years. Well, yes, but then again, maybe it is costing you quite a lot to run those GPUs. Although you might say, yeah, but they're probably using the A100s in a mix with maybe Blackwells or whatnot to run really, really low level, low compute workloads. Okay, I can understand that. But these are questions that are being asked. I would say the biggest one here, the bigger risk is this, the depreciation period. And then, yeah, you have to ask the other question. Do we trust big tech CEOs or do we go with Michael Burry? Because he's the one that has asked the big question, right? He has that short, put on Nvidia and Palantir. So do we trust the big tech CEOs, right? Because they're investing hundreds of billions of dollars into these things. Are they willing to waste all of that money just for the sake of looking cool, or do they know what they're talking about? I would assume they know what they're talking about. Of course, they're thinking long term. So it is very much possible that over the next 12 months, we go into a correction. Some people say a recession, although I've been hearing this for the last 5 years. But you never know. You never know. I just trust those CEOs of these companies that are worth trillions of dollars, that are generating hundreds of billions of dollars in profits over the broken clock. But the questions can be asked. I just think it's just too early to be certain. 3 years ago, ChatGPT came out. I don't think we know all of the answers right now. We've then talked about, and we've seen Zuck talk about overbuilding versus underbuilding. I'll touch on that in a bit. And then this case right here. This is what we talked about when DeepSeek came out, right? This whole DeepSeek drama. Let's say you have 10 products that you're selling at $10. Now you can make that product way cheaper, so you can sell it to 1,000 people, but for only $1. Would you rather be here because, whoa, yeah, I can sell it for $10? Or would you rather sell something for $1, but at least your market opens up to 1,000 people? I think everybody is going to choose option 2. And this is what we've talked about earlier this year. The costs are coming down, which means more people can use a service, which also means more people can start building and creating new stuff. Now, going back to the depreciation talks and the overbuilding and underbuilding, we'll first start with this clip right here.
Going into data centers were allocated towards chips from data storage, which initially was hard drives, and you throw away the hard drives every 18 or 36 months. And then solid state memory would last 2 years, 4 years, 6 years, depending on the type of memory you're using, and RAM had this kind of variable lifetime as well. And then suddenly when you put these processors in to process the data to do AI, that's the majority of the spend and the majority of the energy is going towards the processors. So if you pull up this clip, this is Google's head of AI and infrastructure speaking at a conference here recently.
Where are we, do you think, in the CapEx spend cycle? But more importantly, what are the signals that you guys use internally, right, in your thinking? I mean, you have to plan data centers, whatever, 4 or 5 years in advance. You have to buy nuclear reactors and whatnot. So how do you think about the demand signals as well as your technology signals? And Jeetu, the same thing for you, but from the point of view of enterprise and neoclouds, et cetera. I mean,
we're early in the cycle is what I would say, certainly relative to the demand that we're seeing. So our internal users are, we've been building TPUs for 10 years. So we have now 7 generations in production for internal and external use. Our 7 and 8 year old TPUs have 100% utilization.
And I think that's the key part that's been going on. I made some calls and I checked around with some other friends, and everyone says the same thing, that these 7 and 8 year old TPUs and GPUs that are sitting in the data centers are still being used, and they're being used at 100% utilization. So that actually justifies and validates the depreciation schedule being much longer versus shorter. And I actually think Michael Burry's got this.
Of course, this is just one example. This is talking about Google's own TPUs. We cannot make this a general assumption that every other company has the same results. But this is coming from Google, which is already reassuring. Now let's listen to what Jensen has said before.
And so we need hundreds of billions of dollars of these factories in order to serve the trillions of dollars of industries that sits on top of intelligence. You know, you come back and take a look at software in the past. Software in the past they're software tools. They're used by people. For the first time, AI is intelligence that augments people. And so it addresses labor, it addresses work, it does work.
So you're saying, no, this is not a bubble?
I think we're well in the beginning of the build out of intelligence. And the fact of the matter is most people still don't use AI today. And someday, in the near future, almost everything we do, every moment of the day, you're going to be engaging AI somehow. And so between where we are today, where the usage is quite low, to where we will be someday, where the usage is basically continuous, that build out is we're
and even if the LLM.
And I know some people will remain skeptical because, yeah, of course he has to say that because he's selling the products that all of these companies are buying. Okay, fine. But again, would you rather listen to someone in the industry that has built a $4.6 trillion company, or would you rather listen to people that have not really built anything of value throughout their lives? Moving on to comments that Mark Zuckerberg told us not that long ago. He said that spending big on AI is worth it. It is better to overbuild now than regret later. Mark Zuckerberg commits Meta to a massive $600 billion AI investment by 2028. He said, if we end up misspending a couple of hundreds of billions of dollars, I think this is going to be very unfortunate. But the risk is higher on the other side. And in the last earnings call, he said the following thing. Of course, it's possible to overshoot. If we do, this is what I mentioned in my comments, then we see that there's just a lot of demand for other new things that we build internally, externally. Like almost every week, people come to us from outside the company asking us to stand up an API service or asking if we have different compute that they could get from us, and we haven't done that yet. But obviously, if you got to a point where you overbuild, you could have that as an option. Meta Cloud Services, I call this. And so what we're having right now is very normal. By the way, these are all of the, let's call them, super investors that have added, bought, or sold some of their Nvidia shares. And yes, Peter Thiel apparently sold all of his Nvidia shares. But concluding this video, what I'm seeing right now is a lot of people are trying to sound extremely smart by making statements. To me, it's just too early to say. Yes, everybody can be right. Yes, everybody can be wrong. I'm just saying that 3 years ago, we were not talking about any of it. 3 years ago, ChatGPT barely came out. You cannot conclude 3 years in that this massive revolution is in a bubble, is going to blow up, is not worth all of these investments. It's going to be 5-year depreciation, no 4 years, no 3 years, maybe 6 years. Everybody's trying to make conclusions. We don't know. We don't know, which is why right now I'm more in the camp of I'd rather be with the people that have built up businesses, huge businesses over the last years and decades, than in the camp of those that have been screaming crash, bubble, recession, you name it, every other year, and they've been wrong time and time again. Now for Wednesday, I'm fully expecting Nvidia to beat the guidance, and then I would love to hear them talk about, yes, maybe something for 2026. Are they seeing even more demand? Are things moving even faster? All of that information would be great. I know some people will say, oh, you just hope. Hope is not investing. Of course, hope is not investing, but I put my money where my mouth is, so I am trending in that direction where I feel, yes, that these companies know what they're doing. They have to invest. They are going to make a lot of money from it. Heck, a lot of these businesses are already making money from all of this because they are more efficient. And yes, there are going to be companies that are going to blow up, just like every other cycle. It's just the nature of business. And so all in all, that's about it for me in this video. We'll of course cover Nvidia's earnings report Wednesday after the market closes. See you all in the next one. Bye-bye.